Yeah.
Hello, everyone. I am Nitu Singh, the country lead for APREA's India chapter. A very warm welcome to all of you who have taken the time out to join this very important webinar, the first in the series of Investing in India, covering infrastructure investment trusts, also known as InvITs and REITs, to be covered today and over the next 2 days. With the government of India's thrust on achieving a GDP of USD 5 trillion by 2024 to 2025 and looking to have investments worth 1.5 trillion US dollars in infrastructure over these years, a market not to be missed. So today we shall be hearing from the experts on the regulatory and commercial considerations for the Indian infrastructure market. Please allow me some time to introduce our esteemed panel and the supporting partners. I would like to thank our supporting partner, the European Public Real Estate Association, who are at the forefront of promoting, developing, and representing the European public real estate sector. We have Mr. Matt Fletcher, the Director Investor Outreach of APREA. Mr. Matt Fletcher, the Director Investor Outreach of APREA, who has joined us today. Matt has rich experience in private markets and real estate business development. Thank you, Matt, for your support. I would also like to thank Nishith Desai Associates, one of Asia's most innovative law firm and the go-to specialist for companies looking to conduct businesses in India and for Indian companies considering business expansion abroad. We have Mr. Ruchir from NDA, who's here with us, and he shall be ably steering the panel discussion today. Ruchir leads the corporate transactions group and advises leading global sponsors and LPs on setting up of offshore and domestic funds. He actively contributes to policy development as was involved with the APREA committee in the drafting of SEBI regulations. Thank you, Ruchir. I'm also honored to introduce our esteemed panel to you. We have Mr. Sanjeev Aggarwal, the founder and CEO of Amplus Energy Solutions, a Petronas Group company. It's one of the Asia's largest distributed solar company. He has 25 years of experience in thermal and renewable energy across India and Europe. Sanjeev has won many awards and is considered as one of the top influence in the solar industry. Welcome, Sanjeev. Then we have Dr. Manfred Kupka. Dr. Manfred is having some problem with the camera. He's the managing partner, Bricks Real Estate Advisors, that provides real estate services in the emerging markets with a special country focus on India. Manfred has over 20 years of combined experience in global real estate and infrastructure. Manfred is joining us from Germany today. Welcome, Manfred. Then we have Mr. Saurabh Aggarwal, who's the Managing Director, Infrastructure South Asia, CDPQ, the Canadian Pension Fund. Saurabh's responsibility include assisting CDPQ's investment strategy for South Asia, as well as overseeing development of long-term partnerships in the region with a multitude of stakeholders. He has 20 years of investment and technology sector experience. Very pleased to have you, Saurabh, today. Mr. Milind Joshi, the partner at Global Infrastructure Partners India, where he leads investments in telecom, airports, and midstream energy. Prior to GIP India, Mr. Joshi has worked with IDFC Alternatives, GMR, Tata Power, and PowerGen India. Welcome, Milind. We have Mr. Harsh Shah, CEO and whole-time director, IndiGrid, which is listed InvIT and India's first in the power transmission sector. IndiGrid is backed by Sterlite Power and KKR. Harsh has been on an assets acquisition spree lately. He has been actively involved with APREA advocacy submissions on InvITs to the statutory authorities as well. Welcome, Harsh. Last but not the least, Anish Sanghvi, who is a partner in tax and regulatory services at PwC India, has over 20 years of experience working with international consulting firms. Anish advises on Indian and international tax, inbound investment advisory, and corporate tax, with a focus on real estate, infrastructure, and private equity funds. Welcome, Anish. I would now like to call upon Matt from EPRA to give his opening address. Welcome, Matt.
Thank you, Nitu. APREA is delighted to be supporting this APREA initiative aimed at raising the profile of India as a leading destination in infrastructure investment trusts and REITs. There must surely be interest from global investors in the opportunities that India has to offer. The transparency and governance attached to REITs and infrastructure investment trusts should provide a suitable vehicle for investors once the mechanisms are in place and functioning. There's been progress in recent years and undoubtedly further progress to make to ensure the opportunity is attractive for foreign investors, both in debt and equity investments. I remember meeting the members of the Securities and Exchange Board of India back in the summer of 2016 in London when they visited the British Property Federation to understand how the UK market worked and functioned a bit better. And we've been following and supporting progress since that time. And when we look at the growth of the European listed real estate market, it may give you some interesting insights into the potential for both Indian REITs and infrastructure investment trusts within the correct regulatory environment. We measure investments through the FTSE EPRA REIT Developed Europe Index. It's an index that we run with FTSE Russell and with NAREIT. And when you look at the size of that market by free float market cap back to 2000, 2010, just coming out of GFC, and then 220 basically last month, again, hopefully coming out of the coronavirus pandemic, you see some very interesting growth in the market. And I think this puts some interesting perspective for the potential in the Indian market. In 2000, we saw 80 billion euros in market size. In 2010, coming out of the great financial crisis, essentially 112 billion euros. And then last month, 2020, again, hopefully coming out of the coronavirus pandemic, 210 billion euros. So you can see that there's a significant growth in the market over a relatively short period of time. What's another important story within those numbers is that what you also will see is a far deeper growth in the sectors that are available to in your investment world. So if we take the example of 210 billion euros 2020, what we've seen over the last 10 years is a significant increase in what would previously have been considered niche sectors, the likes of self-storage, the likes of student housing, and a big growth in logistics. What's important with a growth and an understanding of the sector is that then you will find much further investment and far more diverse opportunities available to the underlying investors. There have been recent advances that we've seen in the Indian market. So the reduction of the perpetual lock-in and the reduction in the trading lot sizes is clearly important in enhancing liquidity and attracting further investment. And we believe APREA are correct in looking at REITs' access to bank lending and their ability to raise further capital. It strikes us at APREA that foreign direct investment in REITs and infrastructure investment trusts will improve liquidity and give further investor confidence in the underlying investments. But it shouldn't be forgotten that last year, 2019, was a significant year for Indian in terms of the REITs, with the listing of the Embassy Office Park REIT, notably sharing many of the characteristics we see in REITs, in particular when we think about the importance of income in a world starved of yield opportunities. So we sincerely hope that we're able to see more REITs over the coming period. Once again, we would like to, we at APREA are delighted to support the event. We wish you continued success in growing the Indian listed real estate sector and the infrastructure sector. Thanks to Sigrid and her team for putting together such an interesting and valuable conference, which is undoubtedly all the more difficult in the present conditions. Ruchir, I leave it with you to speak about the panel that you will be moderating related to the infrastructure sector.
Thank you. Thank you so much, Matthew, and thank you so much, Nitu. It is such a delight to be partnering, with institutions like yourselves who are truly developing, and helping the government to develop institutions with a regulatory regime and the experience, that you bring to the table from across jurisdictions. I think it's obviously very, very enthusing, to see how infrastructure has kind of grown as an asset class for foreign investors. And I think obviously with the coming of the InvITs, there has been a very significant change, and I see significantly enhanced interest in infrastructure and InvITs as a product. So I think just for everyone's benefit, I think we are doing this as a two-part session. Today is the first part where we'll discuss infrastructure, different asset classes, and we make the case for InvITs, because for InvITs to be successful, I think infrastructure assets need to be successful. And we discuss the growth parameters, etc. today, and tomorrow will be a detailed panel on the InvIT regime, listed, unlisted, regulatory, and tax. So, and I'm absolutely delighted to see the amount of interest. I think we have close to 400 people listening to us right now across Europe, Japan, Singapore, India, and other jurisdictions. Thank you so much for all those attending. I think there has been, a sentiment that, infrastructure did phenomenally well. I think last year, and it was rather unfortunate because of COVID. I think there was definitely an impact. I think there were certain sectors which were impacted more than others. The sort of the GDP linked value embedded, with embedded volume risks like, roads, ports, airports, etc. suffered a lot. And there were certain sectors with contracted revenue bases like, telecom or power distributions, etc., or the annuity road assets, etc., which did not suffer that much. But more or less, there has been an impact, obviously. But, the only thing that enthuses me every time is that, sometime back we had Saurabh Mukherjee, come here and speak, and he brought about a very interesting point that every single time, whether, whenever there has been a recession in the US and a general global recession, there has been a massive boom in India, whether it is the early 80s or the 90s or the dot-com bust in 2008. Every single time that there has been a recession, India has come up with a massive boom. And I think that's what we are hoping for. Let's see how it turns out. I think the Indian government is extensively betting on infrastructure for the $5 trillion aim of Prime Minister Modi. They came about with the National Infrastructure Pipeline, a very comprehensive document which actually says that there must be an infrastructure spend of $4.5 trillion by 2030 for us to put in the right trajectory to achieve the $5 trillion economy, GDP aim for the government of India. I think there were a couple of themes that sort of became very enthusing last year. I think one was obviously InvITs have been here for some time, but unlisted InvITs were given tax incentive. Thank you very much to Nitu and APREA for pushing this through, and in fact also bringing about the regime. That was, I think, a significant push to the infrastructure sector. Whenever you want to see whether the government is interested in a sector or not, I think one clear distinction is the exchequer willing to pick the tax cost, and the fact that they gave tax incentives to unlisted infrastructure and significant other tax incentives to the infrastructure sector, I think is a signal that the government is trying to ensure that this sector grows and give it all the necessary support. Sovereign wealth fund and pension funds were also given complete tax exemptions, which Anish will talk about now, and we will talk about in greater detail, sometime tomorrow. I think there are different asset classes, and there are different kind of capital pools which are very closely looking at India. There is the historic annuity pool, which is looking at infrastructure as an annuity assets in terms of the stabilized income generating assets, and a new pool which is seemingly more enthused, and I'm seeing a lot of those kind of GPs coming up, are the investors engaged in the growth assets or the developmental assets, and unlisted InvITs will be an excellent way to monetize some of those under construction assets with significant tax incentives. LPs are obviously getting very active as markets mature. I think the global trend of LPs going direct is being seen here as well. And maybe on that theme, Saurabh, let me bring you in with the first question. We are seeing a lot of LPs getting active directly in India. Obviously, I think we saw some degree of managed accounts earlier, not as much of blind pools in infrastructure, but clearly, I think there has been significant LP interest to go direct in India. Whether it is you, it's CPPIB, many other, I even know people are setting up their shop in India. I think they've understood the market. And by design, I think there is a clear partner preference also. And we are seeing a lot of investment platforms also come up. I think the question, Saurabh, to you is, we have historically seen, LPs to be slightly passive, or at best, there might be substantial minority investors betting on the operational ability of either the GP or their operating development partner. But I think you are obviously having a significant team here. So would you be sort of looking only at being substantial minorities in terms of platforms, or would you also be looking at, doing controlled asset kind of transactions? And if the answer to that is yes, do you see other LPs also following your path in a bigger way?
Okay, thank you, Ruchir, for that question and a bit more context around that. Perhaps what I will do is just take a couple of minutes to provide a bit of context of what we are seeing in the market. That should then articulate what our philosophy is for investments in the country, and hopefully that will answer your questions. So in terms of context, despite what I think world is seeing in terms of the coronavirus impact and the slowdowns that is expected out of it worldwide, we see continued, in fact, renewed interest as we discuss the policy matters, and as we understand more and more with the government, we understand that the infrastructure development continues to be a high priority for the government. There is a strong recognition that GDP multiplier effect on growth will come from infrastructure. There is an inherent need for infrastructure development in India. If you believe the projections that urbanization is going to grow at a rate where by 2030 we are looking at 600 million people, in urbanized localities, you are looking at a massive infrastructure growth potential in this country. This is backed by the deepening of the markets and facilitating the investments for the long-term investors. This is also backed by various efforts to debottleneck the issues that investors have previously seen within the infrastructure sector for investments. And therefore, it provides a bit more enthusiasm to go and look out for new opportunities. That doesn't mean there are not enough challenges. There are enough, I think we all know that. But the key operating word for us is the intent, and I think there is clear intent and signal to enhance the infrastructure investments for the country as a top priority. So in that context, the way we have developed our investment philosophy for India, and this is somewhat slightly different from what we have done elsewhere in the world. As you probably rightly mentioned, the historical strategy has been more minority passive investments, but we have looked at different markets in a different way. And in India, what we see is long-term investments, and infrastructure is yet very, very early stage in terms of the assets that you see in the market, where you can just go and invest into assets, large amounts of capital. So there's always this push and pull between the amount of capital that you have to deploy to make it meaningful versus what is available. And because India's infrastructure story is only 15-20 years old in terms of private investments or investors coming in, we don't see necessarily $3, $4, $5 billion worth of assets where you can go and partner with lots and make club deals. There are far and few between. There are some, right? So naturally, what then it results into is how do you for the long term, and then you have to set up platforms. And the strategy we have taken, invest into platforms which are going to be there for a long term, invest and reinvest. So we have a solar platform that we have set up, which is actually a control, or at least a majority shareholding platform, not control. We already own majority in our solar platform. We also have a utilities platform that we have set up, which is the same on the taking care of the growth that we will see in the entire utility space, whether it is generation or distribution or transmission. So that platform will take advantage of all of that. There are other platforms that we are in let's say advanced efforts or advanced to set up the platforms, particularly in the road sector. General philosophy is to look for and set up platforms which have yield potential with stable regulatory policies which already exist. Certain sectors are or certain subsectors are more advanced than the others. Renewable space or road sector or the airports, perhaps you have a better concessionary framework which allows you to build platforms right at this moment. Other sectors are emerging and we are tracking them. And as we go forward, we will look for investments into those sectors. So hopefully that gives you a flavor for how we are thinking and what we are setting up. Happy to take it.
Yes, I'll just take one follow-on question on that, Saurabh. Obviously, you guys are perceived to function with a degree of social license, and respectably so, basis how you function globally. Would it be right to say that your preference would largely be for annuity assets even in India, or will there be or could there be interest in sort of the growth story or the developmental assets also, now that you are setting up a larger team here?
Thanks. That's a very important question, I think, and deserves a little bit of a context again. This is a risk-reward question, not necessarily a particular interest of a particular asset type question. We invest across different types, whether it is annuity or it is market linked. Every infrastructure asset is of interest to us. The key question is, do we understand the risk that we are set out to take? Do we have the ability to price that risk, and can we manage that risk? And if we can do all these three things, then we are not averse to any of the formats of taking those risks. And I'll give you examples. The roads platform that we are out to set up is going to have both toll as well as annuity assets, which we will be acquiring. The utilities platform that we already have will take transmission, for example, which is more or less annuity style, but it will also have solar, wind, distribution, all of the different types of assets. So infrastructure is, we are more and more, we are not yet a developer. We don't call ourselves a developer. We are as investor, but more and more we are able to, as and when we get more and more comfortable with taking greenfield risks, so we are venturing into that, and that's our strategy. Otherwise, it will be hard to support the growth.
Got it. Thank you so much. I think that's very insightful. I think, Milind, if I can just come to you. You're obviously one of the world's largest, infrastructure GPs, and although you and team has been in India for quite some time, and one of the early investors in infrastructure, I think from a franchise perspective, it's still new from a GIP standpoint. I think the question which I had for you is, LPs are becoming smarter. They are just setting up shop on their own. They're making more returns. I think just about a month back, I read a story in Financial Times where CalPERS said that they've made more money in direct investments than through their GP investments, and so this is a strategy they would like to do more. So I think GPs are sort of pivoted to devise new and more innovative strategies, to outshine. So one question is that how do you see that coping up with that sort of pressure and that return profiling? And also, I think another question which you can answer in the same stead is that you are obviously looking at a certain allied uh, infrastructure classes in terms of airports, telecom. Maybe you could give a perspective in that light, and what kind of return profiling do you see, and how do you see yourself differentiating?
Thank you, Ruchir. Good morning and good afternoon to everybody on the call. So it's indeed a privilege, to be invited for this panel discussion, and I'm happy to share, my thoughts with all of you. So, Ruchir, you asked two questions. One is, there is a lot of LP interest to invest directly, and how does that impact the market, or what does it mean for a direct investor? And the second question was with regard to the various sectors. So let me come to the first question, which is, what are we seeing from, direct investments being done by some of the investors? And before I get into, investing issues in India, I think there are just 3 or 4 points that I want to make about investments in India. One is that there is a long history of private investment in the infrastructure sector, almost over 2 decades now. The concession and the risk framework in the sector has evolved over a period of time, and it probably would be fair to say that it's now approaching mature markets. The user experience has also been very positive, be it the quality of infrastructure or the services that has been provided. Case in point being telecom, airports, ports, highways, so on. And more importantly, from a deal flow perspective, I think there is going to be significant deal flow going forward. Given the current situation, the government finances are going to be under stress. So one should expect more and more private sector involvement. So that's one part. Second, we have been seeing initiatives from the government to attract private investment over the last 4 or 5 years. So if you look at new infra build, which is in renewables or roads, privatization program or divestment by the government, all of that has been played. And my sense is that it's only going to increase going forward. So I think if you look at India market, I think it's large enough market for new players to come in and make returns in this market. However, in terms of the strategy which people could follow, I think there are a couple of important points. India continues to be a very competitive market and a complex market. And therefore, if you want to execute a strategy, I think there are 2 very important things. One is on-ground presence, and second is having a very experienced team. I think without this, it's not a market that you can really play on. There are a few things which I think one will have to also bring in if you really want to be successful in the infrastructure market and make superior returns. One is a very comprehensive risk assessment model that one needs to put in place. And I'm not really talking about a theoretical framework, but really about an organization ability to draw upon its experience in other markets in the world, leverage network, leverage your relationship to mitigate some of the risks. So it's not just a theoretical framework, but the risks that you see, how do you address them through a very practical perspective, especially through ability in the organization, in other parts of the organization, or leveraging your network or relationship. So that's, I think, one very important part. The second important part, I think, that will play a role in terms of generating returns is in terms of operational value add. This is really a process of constant or continuous improvement. And again, the key over here is to have very strong cross-functional operations team. And these teams need to have the ability to again draw upon experiences from other markets, what has really worked in other places, in other markets, and how that can be put in an India context. So I think these are some of the very crucial things that are required if you really want to make superior returns. And I guess people who are looking at direct investments in India are putting their minds onto this and would be prepared to do it. But the market remains large, and I think from each player's perspective, I think it would be good that there is more competition in the market. Moving on to your next question on some of the opportunities, and I'll probably focus just on the three sectors that I personally cover, which is airports, oil and gas, and telecom sector. So in terms of airport sector, I think it had a little bit of a rocky start in the beginning, especially around regulatory framework. But over the years, it has really matured quite well. I see almost 4 of the major airports being privatized. Almost 70% of the traffic today flows through privatized airport. A little over a year back, we had a successful privatization program for 6 airport assets. Government has again, put in pipeline 6 more assets in this year, and there's a pipeline of another 20-25 airport assets to be privatized over the next 3 to 4 years. So I think from an investor perspective, this sector does look good, and should be one to basically look at. The second one, which is oil and gas, which is what I cover, largely this has been a sector where there has been investment more from public sector rather than from private. But in the recent past, there has been some opportunities, especially in the city gas networks, which have been bedded out over the last 2-3 years. So there's a significant opportunity that we see in that space. Another opportunity that could come up over a period of time is the privatization program or the sale program of the government of India, GAIL or the sale of BPCL. So these are some big opportunities that could come up in the oil and gas space. Telecom is another space which has done quite well in the last year or so. There has been a bit of a consolidation over the last 3-4 years, but as the COVID impact has shown, I think there has been a data explosion. The sector is also quite defensive. So despite what was happening, I think what all of us saw was an increase in the traffic and therefore, better profitability for the players in the sector. There are, of course, 2-3 areas for infrastructure investors in this space. One being towers, second being fiber, and third being data centers. And again, these 3 sectors are in different stages of development. So tower is quite a mature market by now. Fiber and data center is an area where investments have really started over the last 4-5 years and expected to pick up over the next 5 to 7 years.
No, thank you. Thank you very much. I think we're all hoping for that large fiber InvIT to happen. Let's see. Yeah. Okay, great. I think Sanjeev, if I can just move on to you. I think renewables has pretty much been at the forefront of investor interest, and you have been a very significant player in this asset class. And this is also the sort of the growth asset class which some of the new GPs are looking at, or some of the global GPs are looking at. And it sounds promising. It has probably been less impacted than other sectors in terms of this, in terms of COVID crisis. What, according to you, when you discuss with investors, etc., what, according to you, would be the critical challenges that an investor should look at or consider while investing into a sector such as this?
Yeah, thanks, Ruchir. It's a pleasure to be on this panel. I think the issues in renewables are actually no different from what we see in other infrastructure sectors. One area that we clearly see is about the certainty of the policy, and this is, to my mind, is the biggest issue that remains in the minds of any investor, whether it is the Indian investor and so much more for the international investors. Because what people want to invest on is something. I come on a premise that this is the policy and this is the regulation, and therefore I am investing so much. Essentially, what we are doing is we are buying a continuing annuity, right? When we are investing in the infrastructure sector, so we want to make sure that whatever we have invested, it actually comes through. And there, the importance of having the regulations, the regulatory system being very strong, and the sanctity of contract. I think these issues become extremely important. So if you look at the renewable space, in general, there is a lot of interest because this is considered as one asset class which which India needs. And to be fair, to be honest, the government, at least the central government, is very, very positive about the renewable sector, and they are promoting, they are trying to resolve all the issues, whatever are the issues being faced by the investors. So literally, we are having a call with the minister or the secretary at least once a week or once in fortnight during these times. So the minister himself is trying to understand what are the concerns which are being faced by the industry and trying to address them proactively. Having said that, we can't really say that this renewable is separate from the larger power sector. We understand there's a larger power sector and there are issues in that because of the distribution companies' overall creditworthiness or the financial stress that they keep on facing. So which actually gets mixed when you're trying to look at a sector like renewable. And that's where I think the second point, apart from the policy and policy certainty, which becomes important from any investor point of view, is that whether your customer is in a position to pay. Very simply. So if you're manufacturing something or if you're creating something, you want to make sure that your buyer is a willing buyer and is in a position to pay. That becomes the important point, the second point. And I think that is where the most of the stress is being faced in the power sector, because the distribution companies are literally in perpetual losses. And if you're not selling to a buyer who has all the money to pay you, then there is a problem. And I think that's where we have a little bit differentiated our business model in Amplus, is to go more for the customers directly. And if you're working with the customers directly through an open access plant or a captive plant or a rooftop plant, at least we know who we are dealing with and what are the chances of us getting paid, right? So this is an important differentiation that we have done, that we have taken away a lot of credit risks which are prevalent in the distribution system and trying to work directly with the customers. But that creates a separate set of problems, which is like dealing with the regulators at all times to work out what works in open access, what doesn't work in rooftop, net metering, and all those types of issues. But the good point is that the government remains completely committed to renewables, and the issue about these regulations and opening up the market is being addressed to some extent by bringing an amendment to the Electricity Act. So which is going to again open up these markets where we can sell directly to the customers by reducing the cross subsidy surcharge, or by making open access compulsory, or by making captive simpler. I think overall the thesis or the focus of the government seems to be opening up of the market, and which is also very important if you look at the overall technology space. Apart from the solar, which is becoming main part of the renewable, we are also seeing storage coming into picture. We are also seeing electric mobility into picture. So it's becoming a very different energy ecosystem, and there are opportunities everywhere in that ecosystem to invest. So a lot of things will start moving from a regulated space to a market-focused space. These become, probably at some stage we have to start taking market as a contract, and we have to start taking the market risk rather than taking just like, okay, I have a 25-year PPA, so therefore my cash flows are certain. So maybe the markets are shifting, the entire energy ecosystem is shifting, and we have to find out what really makes sense. So I think those are the points to my mind, how this entire sector is shaping up. But I think from investors' point of view, clearly the policy, the law of the land, and to some extent what are the market opportunities, these remain important. So the market is large, but clearly you have to find out your own area, what really works for you from the risk reward perspective.
Thank you so much. Very insightful. I'm going to come back to you, Sanjeev, on I think there's a question on why no renewable company has gone into an InvIT till now. Is it because of declining cash flows from Aditya Birla? But maybe I'm going to ask that later to the panel, and maybe Harsh can also add. But let me quickly come on to come to you, Harsh. You've always been you conceptualized this entire idea of IndiGrid InvIT, made it super successful. We had Hardik from KKR last time speak here, and he just couldn't couldn't stop admiring how well you've done, and obviously in many ways it's become the sort of become the poster story with great IRR returns and all that. But tell me one thing: do you obviously yours was way, and there was a regime with private listed InvITs, and now they've also allowed for unlisted InvITs. And unlisted InvITs can now hold developmental assets also, which are under experience, etc. And you've been on most of the, every committee I see you being active. Do you feel that unlisted InvITs will be the way to go for most of the infrastructure assets? Obviously, being sort of being public ready, being public InvIT ready. So you move over to an unlisted InvIT now. Tax incentives are great, and then as and when the market improves, you sort of list it to unleash value.
Sure. Thanks, Ruchir, and thanks for having me on the panel. I think my views are that we need to understand what is an InvIT. InvIT is nothing but a better way of owning a particular business, right? Earlier it was company. InvIT is more regulated with better corporate governance, right? So we start from there. InvITs provide an opportunity to own businesses in India with a better corporate governance and with greater shareholder rights, etc. And therefore, in the past, there was anomaly that only listed InvITs had tax arbitrage or tax benefit. That's been neutralized now. Having said so, the InvIT structure did not just get formed because of tax incentives. It got framed because investors in general wanted a better governed platforms, which has very focused business models, right? And that's something which exists for both listed and unlisted InvITs in India today now. So I think like a normal equity company, where there are public markets, there are private markets, there are private equity players, there are listed capital players, there are pipe players. It will continue to happen in an InvIT market as well, that there would be both listed, private, unlisted, and listed InvITs, depending on the asset class, depending on the evolution of that asset class in India, size of the sponsor, and the business plan, right? So, for example, if the objective of the investors or the owners is effectively to run a public listed platform and realize the value in a better way, I believe it will be difficult to beat a publicly listed platform just by sheer number of people that can participate and the value that liquidity brings in any owning any business. Having said so, in infrastructure, there will be cases where you have developmental assets, you have GDP linked asset, which needs to prove track record, etc., before it can be owned by, I would say, let's say, variety of investors, both retail, pension, insurance, etc. And maybe in the interim, you want to keep it unlisted to prove the track record and still, achieve the objective of having some bit of governance and better tax efficiency. So I would say that the market would have all of these platforms working simultaneously, depending on the asset class, depending on the objective of the sponsor or the financial investors. So I would say it's a market common for all. And it's good that SEBI has enabled that as well now, which ensures that investors can participate in a way they wish to in different types of assets. So it provides more flexibility.
Maybe Harsh, yeah, and we'll obviously discuss InvITs in greater detail tomorrow in the detailed presentation. But maybe on that, Harsh, if you could just give a very quick 3-minute roundup on IndiGrid, how well have you performed? What are the yields like? I think that'll be a good sense to be honest.
Sure. Thanks, Ruchir. So IndiGrid listed in 2017 with about 4,000 crores of assets under management. And today we are about 12,000 crores. So we have seen about 3 times growth on assets, NDCF, EBITDA, etc. Largely on the back of capital raising and asset pipeline. And what we started IndiGrid with was a focused business model with owning only operating assets which are not GDP linked and only transmission lines to start with. And now we have taken approval to expand into solar assets, and we'll be looking at a good, credible counterparty solar assets as well. So from our perspective, we have delivered a promise. We've remained very low volatility stock, if I may say, over the last 3 years, with a beta of less than 0.2, and the total return story, what we have promised to investors, that will remain largely dividend yield stock with a limited growth. And therefore, we have delivered about 12% return year on year on dividend and about 3% growth. So that's what we are focused on. And I think in general, a lot of positive developments have happened, not just for IndiGrid, for everyone in the market, and in which higher leverage has been allowed, which makes it a little bit more attractive for investors to own it. Lot sizes have been reduced, so the stocks have become more liquid. That helps in terms of people to buy and sell in the market. And a lot more regulations are coming out with respect to rights issue, preference issue, etc. by SEBI. So I think in general, it's been a 3 years of great experience for IndiGrid. And our goal is to become 30,000 crores of assets. And where we are today, we are well capitalized, and both in terms of equity and debt. And we are seeing a good and healthy pipeline to grow there. So thanks.
Very nice. Thank you very much. I think I hope these numbers are enthusing for those who are listening. Okay, great. Manfred, if I could, just come to you. Thank you very much for being on the panel and bringing the sort of Indo-German perspective. You've been involved in sort of Indo-German infrastructure initiatives in the past, and while the experience may not have been as optimal, I understand that European investors are very keenly looking at India, some of which are being represented by you. Can you throw some light on what is it that that the investors are looking, and what are the ESG standard compliance that sort of drives investments purely from a German investor standpoint?
You hear me now?
Yes, please go ahead. Yeah.
Oh, sorry. Thank you, Ruchir. Well, let me start with one word what I just recently read about India from Atlas Foundation. Jonathan Ward, who's the founder, it's a US-based think tank consulting firm, and he said India today is the most important emerging market. And I was really, I mean, it feels good to hear that. See, I'm doing business in India for the past 15 years, real assets, infrastructure, and real estate. And why is India now the most important emerging market? Because you are in the middle of urbanization. But does that mean people are coming to the cities, find jobs, consumption? So yes, of course, this is the right time to invest. And if we're talking about urbanization and cities growing, there is, and this is, I think, a very unique thing about India. You have, since 2015, the 100 Smart Cities initiative, which means you are dedicated to build 100 smart cities, green cities, clean cities. And that's how we get to ESG, which has become so important in the past years that what I've seen, any of the big pension funds and insurance companies who are investing have guidelines which require ESG compliance. So I think what it makes really attractive is that ESG compliance is what you can find if you invest in infrastructure. But I think we have to differentiate between infrastructure assets, large assets like airports or roads outside of the cities, and the cities themselves. So, as an investor in infrastructure in India or any other emerging market with currency risk, with a lot of other risk, typical emerging market risk, you need to mitigate your risk. After all, because you're bound to the regulations, and they're very strict in Europe and in the US as well. So what you're looking for is risk mitigation. How can you achieve risk mitigation if you are investing in infrastructure in India? What I believe, for example, if you're investing in a smart city, not in the whole, but in integrated parts. So as an example, green buildings plus green urban mobility, which could be, affordable rental housing or, developments of housing plus a road system or a traffic system. Both of it are generating cash flow. That's a point of risk mitigation, but in the same time, the opportunity to model a cash flow that is attractive for a pension fund who needs regular income. So I think any smart city infrastructure investment is green, ESG compliant, and could be very attractive for investors. So, but in addition to that, what are the needs that you have? So when I'm talking about risk mitigation, personally, as an investor, I would like to see, of course, the government, so India, in the boat, in the same boat. I mean, we're in the same boat together if we're talking about the COVID pandemic. But I think it's the same thing if we're talking about complex infrastructure. I know this is very difficult to achieve, but see, yesterday I was getting an update via internet on all the various programs that Germany has initiated with India to support infrastructure investments. Just recently, in November last year, Merkel and Modi signed a €1 billion urban green mobility program. So what I mean within the same boat together, me personally as an investor, if I know that, for example, the financial investment Germany is bringing in a certain asset or bringing in a certain integrated smart city investment, for example, as a first loss piece, I would be willing to put in additional money. So I don't know how we can achieve that, but I hope it's clear that it's not a matter of necessarily India putting in equity, but just using the sources that we all have. What I realize—
Absolutely, I think there has to be some degree of participation by the government if they want to encourage. Otherwise, I don't think smart cities on their own can function that well with private capital. That's great. So, so Manfred, if I can, sorry, just we barely have 5 minutes, and I'll just have to quickly run over to Saurabh because he has a hard stop at 2, and there's one question that I really would like
Sure.
panel to answer, and especially Saurabh. So I think Saurabh, we heard last time at our at our session, we heard some of the larger sovereign wealth funds say that that they may get into infrastructure credit, and infrastructure has largely been a game of equity for foreign investors, but I think one change that is happening is that for whatever good, bad, ugly reasons that had happened, banks and NBFCs have burned their fingers with infrastructure assets and therefore are reluctant to give money. And therefore, I think the only door that is left to knock for these infrastructure promoters to ensure financial closing, etc., is to go to special situation funds, which would be willing to, which lend at like a 12% dollar return or something like that, which translates to about 20% rupee terms, which is very expensive. Now, is that a space, and obviously the government has been very keenly looking at DFIs and pension funds, etc., as the Masih has to come and resist the stress in the infrastructure sector. Is this high yield debt something that Saurabh, you as an LP and Milind, you as a GP, be looking at participating, of course, considering the enforcement risk, etc., that India does bring in?
Yeah. Thanks, Ruchir. So I think this is consistent with what you may have heard from other LPs and other long-term investors. We are a large debt investor worldwide, right? So 1/3 of our capital almost does go into fixed income related products. So no reason why we shouldn't be able to do this in India as well, right? We have the appetite, we have the interest, we have the capabilities. However, what it needs, as you've heard other panelists, and particularly I think Milind mentioned this as well, you need very skilled, specialized teams on the ground to make sure that when you are setting up platforms for debt investments, you have the ability to manage. There are a multitude of reasons why debt investments have failed in the past, particularly in infrastructure sector. I think we have the learnings from that, which we can bring to bear and we can use to create platforms. It's happening. It's already started to happen, but it will take time. So we will certainly be there as and when our teams get ready to start looking these opportunities. We will be strategic. We will first make sure we understand which way we play that debt market, and thereafter we set up the right level of teams, partnerships, whatever is necessary, and then we start investing. So for sure, I think it is on the radar, not just for us, but also for many other long-term investors.
Milind? And maybe Harsh, if you have something to add very quickly.
Yeah. No, I think sort of summarized it quite well in terms of the challenges which have been there in the sector, especially the credit space. So I guess it's still not matured enough. I think there will be more interest going forward as infrastructure investing picks up. And my guess is, I think we need to give it 2 years time before it. One of the challenges that I see is some of those situation funds which are based overseas. They look let's say. While if you look at most of the infrastructure in India, essentially the underlying is rupee based. So I think that dynamic has to change. So unless there is promoter funding, if I can call it that, available in rupee terms, I think it's going to be a difficult market totally.
Harsh, just quick comment. Otherwise, we'll just have to go to Anish.
So I think quick on the private credit market. I think we don't have a developed bond market as well, right? So there are a lot of one side regulatory framework related regulation, be it RBI or SEBI, they need to form up, which ensures that even the private credit, it can happen in a simpler way, and there are no obligations to sit down for 3 years when it can happen in 6 months, right? So I think to plug in the specific hole and to provide flexibility to private credit funds is partly a regulatory and partly liquidity that will happen with regulatory enablement. So it's largely a regulatory play today. As Saurabh mentioned, Milind mentioned, capabilities exist in India, funds interest remains in India, but is there a conducive environment for it to take it from 5x from what is today? That's something which is questionable.
Yeah, no, I completely agree. I think there are obviously some regulatory wrinkles that need to be ironed out, because I remember, there were funds that were very keen to invest at very competitive rates in infrastructure credit. But the challenge is that when you give a credit to a concessionaire and take an example of taking shares in pledge, when you invoke the pledge, you need the government approval, and that government approval is anyways need to be applied by the concessionaire himself. Now imagine you are invoking a pledge against the concessionaire and you can't get the approval without him. So, these are sort of elementary issues that I think we need to sort out. And all of us are very actively involved at the the government level. I think hopefully they sort of. I think very quickly, if I could pick it up, if I could come to Anish from a tax standpoint. Anish, obviously, there's no tax consultant can ever be very happy with the government. So there will always be some creases. But if you could just set out the big incentives that you see that sort of incentivize infrastructure investments, I think that will be great. And then maybe you could just help us understand what is it that would really be the driver for companies to move to an InvIT structure from a, what's the tax optimizing effect on this?
Thanks, Ruchir. Let me just start with segregating the question, and I know I have very limited time, but I'll just try to keep it fast. So let me just segregate it to 2 parts. One from the concession or the business perspective, what benefits typically are applicable or available to a business, and the other will be from an investor perspective. So from a business perspective, earlier we used to have tax holidays which were long term, which were available for 10 out of 15 or 10 out of 20 years, depending upon the sector that you were looking at. But those tax holidays have now been stopped. They were applicable until April 17. Of course, for whoever has already started their tax holiday, they will continue to get the holiday for the remaining life. But any new projects that come up do not enjoy these tax holidays. But what has changed now is for them to also have any new company which is started, it's an infrastructure facility like a road, airport, or something similar, can avail of a capital expenditure linked deduction. So their entire cost of construction or the cost of concession, all of it put together, could be availed as a deduction in the very first year, and that loss will be available from this specific expense will be available for substantial periods of time to be set off, such that effectively it could be treated as a tax holiday. Though this is meant for infra facility, power generation is excluded from an infrastructure definition, from infrastructure facility definition, and they have a separate provision where they have a substantial reduction in the tax rate available. So they can basically get taxed at 15% headline tax rate if they are not availing any special incentives or deductions. So that's a special regime which is available, which started effective or which got clarified earlier this year, that it may be available even for generation of electricity. Now, this is from the perspective of business. When I look at investors, the biggest advantage is coming through an InvIT. That's the biggest advantage that you get. And other than InvIT, and I know tomorrow you all are going to have a session on InvIT benefits, but other than the InvIT, the biggest benefit that has now been put in place is the sovereign wealth fund and the pension fund exemptions that basically exempt income of any kind, from interest, from dividend, for capital gains. All of this is exempt in the hands of the sovereign wealth fund or the pension fund. The key issue here, though, is you need to register the entity which is making the investment as a sovereign wealth fund, and there will be a notification process which the government is still working on, even though the exemption has already begun. It's from 1st April 2020, and the whole of first quarter is out, but we still don't have the notification process in place, which enables them to start claiming exemption. So once they get notified, they will be able to claim exemption on these aspects. There are, of course, certain conditions to be fulfilled. And what we've been discussing with the government informally is they're going to come out with the notification process, as well as guidelines to interpret the provisions, the exemption very soon. So we'll wait for that. But from an InvIT perspective, again, maybe a minute or two on that. From an InvIT perspective, you still have the biggest advantage of dividends continuing to remain exempt in the hands of the unit holders. So the SPVs, when they distribute dividend per se to the InvIT and InvIT to the unit holder, there is though one condition which is very important. So if the SPV actually is under the new regime of 22% tax rate, which is without application of incentives or tax holidays, then that kind of company distributing dividend does not enjoy the exemption. So that is really critical. So you need to evaluate the SPV structure which is being put under the InvIT, so as to make sure the dividends get exempted in the long run. Of course, there are structures which you can look at where substantial part of the distributions are earning out of interest, in which case this may not be relevant. But that's a good mix of issues that you need to work around when you have to move to an InvIT structure. I'll just take a pause. I think there's not enough time, and I'll rather hear some questions.
No, this is good. Thank you very much. I think if anyone wants to answer this question, that why haven't there been enough renewables why haven't there been enough InvITs in the renewable space? I think that will be great. Anyone from the panel can take it.
I would take that if that's okay. So
yeah,
I think,
go ahead.
I think this is a view that a year or two before, most of the renewable energy companies which have a large portfolio had filed for an equity IPO, right? So it's not an InvIT. People did prefer a listed platform which enabled flexibility of doing under construction and opco businesses together and probably offer a better value. I think that was the view, but I think that's why nobody initiated that is our view. However, I think there have already been discussions around several renewable energy, including our own InvIT looking to expand and buy renewable energy asset, while we'll remain majority transmission InvIT. So it's not that renewable energy doesn't fit in the InvIT well; it fits perfectly well, and believe there will be few InvITs that people will see owning renewable energy asset. If at all, one handicap, which I may say, is SEBI restricts the leverage to 49% of value and only allow higher than 49 if the InvIT is rated AAA, which on a standalone basis, I believe renewable energy PPAs would find it difficult. And this leverage headroom may make it slightly difficult in a public space. However, in a private space, unlisted space, this is not there. So I'm sure we'll see some renewable energy InvITs in unlisted or private space soon as well.
Great. I think we are just on time. Maybe I can just conclude the session unless anyone has to add any comments. Saying thank you very much. I think we will have a detailed presentation on InvITs. I think I see a lot of questions here on InvITs and private InvIT structure, sponsor, manager issues. I think we'll discuss all of that, governance regime, tax in detail, in time. Please join that, and you can send us questions in advance, which we will take up. I think thank you so much, everyone. Nishith bhai, I see you.
Yeah, I think I know
you can just
time too much. Only one short thing. I think Manfred's point. I think we have still taken smart city very lightly as a statement of like intent. We have recently worked on the first smart city project. It's coming up in Pune. But I think how do you get further on? Maybe tomorrow so we can discuss this aspect if Manfred could join us back. But it was a very good statement, and there are two parts. One, infrastructure part of the smart city, and second is the governance and the regulations. How do you go about it? And number three, that funding, each smart city would cost about $150 to $200 million. So they are very good opportunities. They are not large projects, but that's another thing. And I think we can discuss more about that as we go along. But now, given the reverse migration that has happened in some respect, so smaller towns will begin to grow bigger. But before they grow big and undirected, growth, it would be useful to take into account the smart city elements. And I think we can have more orderly growth. I don't want to stay more to say at this point in time, but I think all the friends here, you've been wonderful. I think it provided a great insight. I've been here from word go. But thanks a lot for joining us in so many numbers and all the participants. I think they are huge participation, wonderful. Please join us for more sessions. I think we can do a lot more constructive thing and change the world for the better together. Thank you so much.
Thank you very much, Nitu. So with your permission, if we can conclude the session, thank you very much to IPRA, Matthew. I hope we will do a similar session for NAREIT, which is North American REIT investors. I think scheduling and time issues, we could not do it for them, but we'll probably do a similar session for our investors on the West Coast. Thank you so much.